Well, basically, if you look at a chart for consensus growth for the U.S. economy, it's at 2.5% right now. And if you look back over the last 2-3 years, the Fed fund futures and the consensus economic growth for the United States have moved lockstep with each other until about the last 6 months, and they've really consciously decoupled, or uncoupled is Gwyneth Paltrow's words, when she split with Chris. And one of those have to give, basically. And I think this weekend's probably going to determine the direction of that. Either we're going to have lower GDP estimates, or we're going to have to see some of these 3 or 4 Fed cuts that the market's now pricing in over the next 12 months. I think we'll probably have to take some of those off the table if we do see any progress on trade. So I think we're going to see a recoupling of GDP and Fed fund futures, not so much with Gwyneth, though.
Yeah, there you go. The conscious uncoupling between that. I like what you did there. Who's going to be right? I mean, do you think the bond market may actually have it wrong?
The bond market on 10 years probably, we think they're going to stay around 2% for the rest of the year. I think Fed fund futures are pricing in a too negative situation for growth or a too dovish situation for the Fed. I think even if you look at Bullard, who's probably one of the most dovish members of the Fed, he's really talking down 50 basis points. I think a lot of the market participants were looking for 50 basis points in July. He's saying 25 is appropriate. It was appropriate in June, in his opinion. And the market's pricing in 3 cuts this year. I don't see it. I think if we move into a recession, you get 3 cuts this year. We don't expect a recession. We expect the trade truce with China and the United States is enough to keep a sub-trend growth alive, and you don't need the Fed cutting 3 times in that environment.
Do you think there's a relationship between what happens with trade and the Federal Reserve? I guess the irony, Patrick, might be that if we get some kind of a deal, that would be good for the equity markets in the short term, one would assume, but yet it might take the Fed cut story off the table, perhaps.
Yeah, I think the long-term driver of equities can't just be the Fed, though. So in short term, definitely everything's rallying because when your alternative zero interest rates, you've got to put your money to work somewhere. So equities benefit from that. Economic growth is going to be the driver of equities in the long term. So things that are pro-growth eventually are going to translate into higher equity prices. I think it's a win for equities if we do get the trade deal, despite the fact we're not going to have the Fed cutting as much as the market's pricing right now.
You know, I hear you. I guess one could have argued with you a couple of years ago that this can't be a Fed-driven market 5 years ago, and yet here we are, still a Fed-driven market, maybe more than even we were a couple of years ago. Does the Fed ever really step aside?
I'm not sure. It really was looking like they were going to in 2018, and the weak Q4 really pulled them back in to stabilize markets, and now it's really what markets hanging on to. This week, we've started to buy some internet companies out of China again, and the premise there is that we get a deal, and if we don't, Powell comes to the rescue, basically. So I think everyone's pricing in this Powell put. The Fed's indicated they're there. If there are any tensions on trade, if there is a market sell-off, they're showing they're reactive to markets right now. It's probably got people too complacent, but it is the Fed driving markets right now, and all other central banks have to compete with that. Draghi, just before the Fed meeting last week, indicated he's ready to cut just to make sure the euro doesn't really appreciate against the backdrop of a dovish Fed.